Hi, I'm Chip Rogers, and welcome to the AAHOA Educational Experience. This week, we are again talking about taxes, particularly offshore taxes in these next two episodes. And joining me this week, two very learned attorneys. We'll start with Rahul Ranadive with GTEC, which stands for, again?
Global Tax and Estate Council.
And you practice in both Florida and California, correct?
That's right.
Well, you go to where the people are. That's a good thing. And Parag Patel with the Patel Law Offices, based out of New Jersey. Do you practice in any other state?
New York and New Jersey.
Yeah, you go to where the people are as well, so
I do.
Good move. In the last shows, or last set of shows, we kind of lay the foundation of having that income that is created in a land outside the United States, and how do you deal with that? How does the IRS look at that? But you had mentioned something in one of the earlier shows that I think is important. Explain the difference between disclosing foreign income for the purposes of simply disclosing it and having to pay taxes on foreign earned income, because it's actually two different things, isn't it?
Yes, it is actually two different things, and they're completely unconnected. So you may have a foreign business activity, in which case, if you structured it properly, you may not pay taxes on it until you actually bring the money back to the U.S. But there's still information reporting that needs to be done on that business. That may be a Form 5471 for a corporation, but more likely it's the foreign bank account reporting that needs to be done. And that's, again, completely unconnected to whether you make money or not. It's just the existence of that bank account in a foreign country that triggers the reporting once the aggregate of the bank accounts crosses $10,000.
And to follow up on that quickly, so that's an important point. If, let's say I start a business in some other country, and then it just doesn't go as planned, and I actually lose money. Even if you're losing money and you recognize you're not going to have any obligation to pay taxes, because you have money in the bank, you still have to file those reports.
That's right. If the money in the bank is above the threshold amount,
right,
which is $10,000.
Which of course would be a worst case scenario if you lost money and then you get hit by the IRS.
Right.
That's not what you want. But you also mentioned something that I want to follow up with Parag on, and that is setting the business up properly up front. How important is that? I mean, because if you do it wrong and then you earn a lot of money and you want to go back and take advantage of some parts of the law that could have helped you protect some of your assets, it may be too late unless you do it right to begin with.
Yeah, absolutely. The choice of the way you do business in the United States or in any other country is very important. The way you enter is just as important as the way you exit, and often it's important to think about that exit when you plan that business. So sometimes, for example, if you want to do business in India or some other country, it's important to look at tax treaty benefits. And just in terms of background, the United States has tax treaties with many, many different countries. For example, there's a tax treaty between the United States and India. People sometimes tax attorneys structure an investment funnel it through a third country sometimes to take advantage of certain treaties between the United States and maybe a third country, and then going to India. So it's important to take a look at this very carefully, craftfully, meaningfully, to plan the investment as well as the way you're going to take the money out and perhaps the exit eventually. Right,
and everything you're suggesting is, it's legal means of making sure that you don't have to pay any taxes that you actually don't owe. I think somebody very wise once said it's not patriotic to pay more than you owe. So you can write the government more money, but you don't have to. For all of us, growing up, you hear about tax havens. Do tax havens in the world of 2011, where everything is done electronically, it's a flat earth, as Thomas Friedman writes about. Are there tax havens out there? Do those things still exist?
Oh, they definitely do exist, and that's why the IRS is increasing their scrutiny on these countries. For example, in 2009, the reason the first OVDI program came about was because they got a disclosure from UBS about undeclared bank accounts. And Switzerland, traditionally has been a banking secrecy country, but there are also other countries around the world, Cayman Islands, British Virgin Islands, etc., where there are no taxes, and so that's where the name tax haven comes from.
Right.
So they still exist, and the IRS is very vigilant about, now that they have the enforcement power, to go after U.S. people that have bank accounts in these foreign countries.
So just because you have a bank account in Switzerland and or Virgin Islands, British Islands, or whatever, just because the information may not being released, it doesn't release you from any tax obligation that you have in the United States, correct?
Absolutely. The fact that this is the U.S. tax system is based on the honor system, and the United States is very aggressive over the past couple of years. In fact, when President Obama was campaigning to be president in 2007 and 2008, he was essentially telling prospective voters that there are U.S. people that have foreign accounts earning foreign income that should be taxed by the IRS, and the IRS is simply not able to collect that money, and they're not doing what they should be doing. So as a result of that, some of the very first actions that President Obama took were to increase the scrutiny of the foreign activities of U.S. taxpayers, and that led to some major changes. In the previous episode, we talked about this foreign bank account reports and disclosure, and this question on your income tax return on Schedule B, whether you have a foreign account. Actually, starting in 2012, so just a couple months from now, the IRS has a form which actually goes retroactively to the current tax year. So everybody watching this show who's going to be filing a return, which is most people, you'll see when you file your individual income tax return in April, that when your accountant presents it to you, if you have a foreign account that exceeds $50,000, not only do you have to say, yes, I have a foreign account, not only do you have to report that foreign income, but there is a third query that's made of you, and you have to file a form, an additional form that never existed previously. And they ask you many more details about that account. And then on top of that, you have to file the foreign bank account report that's not filed with the IRS, but that's with the Department of Treasury.
Right.
So this is all very complicated. And the thing to remember is that the IRS and the U.S. government is closing in. For example, India is not a tax haven.
Right.
It is not a tax haven. So you have to report your activities. You have to report your income. And all of these different forms that are coming now, and these various initiatives that the government are taking, this isn't the end. This is the beginning of the whole process where the government wants to know, and people should be really on the lookout for that.
Do the foreign governments work with the U.S.? I'm sure some do, some don't, but in general, do they work with the U.S. tax collectors?
Well, in theory they do. They, through the tax treaties, they have the mutual assistance provisions.
Right.
In reality, whether the bureaucracies work with speed enough to communicate in real time is a separate issue, but the mechanism exists for the IRS to go to the Indian government and request information about particular taxpayers.
All right, so in the next part of the show, we're going to start diving into the Offshore Voluntary Disclosure Initiative, which is I don't want to mischaracterize it, but in a sense, somewhat, I don't want to call it an amnesty, but at least an opportunity for people to come forward and maybe won't get hit quite so hard by the IRS. So we're going to talk about that coming up in the next segment. You do not want to miss that. This is Chip Rogers for the AAHOA Educational Experience. We're talking about taxes, and we'll be back right after this. Welcome back. I'm Chip Rogers with the AAHOA Educational Experience. We're talking about taxes, making sure that you comply with the U.S. tax code so that you don't get in any trouble. And the two gentlemen with me this week, both Rahul Ranadive and Parag Patel, are experts in this field. And we've been talking about basically your obligations as a taxpayer, U.S. citizen taxpayer that has business interests elsewhere. But a lot of people, as you had pointed out on a number of occasions, Parag, they just simply don't know about this. So what the federal government has done, and correct me if I'm wrong here, has said, all right, if you've made some mistakes, if you didn't know you were supposed to do this and you weren't aware of your legal obligations, we're giving you kind of a timeout here to file all the things you were supposed to file. You're still going to pay your taxes. You'll probably pay a little bit in penalties, but you can, if you do everything right, we're not going to come after you as if you were a criminal. Is that generally what they're saying?
Yes, the OVDI program is geared towards getting people to come in from the cold, so to speak. So part of the program, it's kind of a carrot and stick. They guarantee no criminal prosecution as long as you come in and you do the disclosures for the 8 years. And it's, as you said, a limited amnesty. So you're not going to get off completely 100% scot-free. There will be some penalties. One of the biggest issues right now is the level of the penalties and whether that's fair or not given the circumstances. Like you said, you do pay tax on all of the income, interest income that you may have not have reported, and you'll pay a non-reporting penalty on that. But the second half of the penalty, the 25% of your aggregate high balance, that's really where people get hurt and where people are complaining about the fairness of the program as to whether it's appropriate to take 25% of someone's net wealth just for not knowing about these arcane reporting forms.
So I want to be real clear on that, because I didn't specifically know that myself. You can come forward and say, yes, I have foreign bank accounts. Yes, I've earned income. I've earned interest. I understand I didn't realize that I needed to report this. I'm now reporting it. So they make you pay the taxes. They hit you with late fees, I suppose. But they also take 25% of what you have.
That's the OVDI penalty,
right,
which is 25% of the highest aggregate balance in your foreign bank accounts. And that's for the prior 8 years. So the aggregate high balance may have been in, say, 06 or 07
when things were going well.
When things were going well. And your balance may have decreased since then, but the penalty is going to be applied on that high year.
Wow. So, but of course, most people say, well, why would I do this? But they hit you on the other side by saying, if you don't do this, not only are we going to take the money from you, but you could go to jail.
Yeah, absolutely. That's the problem here, is people are afraid.
Right.
And in fact, there are many South Asians in the United States that were in a panic. And I'm speaking in the past tense, just so you know, is that because the OVDI program is over, it ended on September 9th.
Right.
There still are opportunities which we can talk about, which we will talk about today, but what can be done. But the reason why people are paying this unfair penalty is because, frankly, people are scared. And because of events that occurred with HSBC Bank India, where they were investigated and subject to a subpoena, I suspect that the majority of people that went through the OVDI program in 2011 were Indian Americans. The colleagues, my colleagues, Rahul's, including Rahul, will probably attest that most of my clients that went through the program, I had almost four dozen that went through the program. They were all Indian American, and they were upset. They were upset. It's an unfair penalty, and I've made that argument to IRS supervisors that it's unfair, Trip, and their response, unfortunately, was it's a voluntary program, so you don't have to come in if you don't want to. And the other thing that they said was that it's not a tax, it's a penalty. So it's not an unfair tax, because tax, as we all know, is usually based on income. This is a penalty being assessed against the
wealth,
fair market value, against wealth, which really doesn't really exist in most income taxes in the United States. You have an estate tax, which is based on wealth, but we're talking about income tax today.
Right.
And income taxes are based on income, not on wealth. But this is not an income tax. This is a penalty.
Is this now, we want to be clear, the Offshore Voluntary Disclosure Initiative, this is not the first time that the federal government has done this. But is this penalty, this 25%, we'll call it wealth penalty, is that the first time they've applied this penalty?
It's the second time. The 2009 program had a 20% penalty for missing the information returns. And they got about 15,000 plus filers that came in 2009. Most of them were UBS clients. This time around in 2011, they upped it to 25%. And like Parag mentioned, a lot of them are HSBC clients because that's the bank that's under investigation right now. So the IRS has always had a voluntary disclosure program in effect, and this is now the third time that they've come with this limited type of amnesty where you have set penalty structures beyond than what the normal penalties that would apply to you. So they have tried it before, and they've ratcheted it up this time in 2011.
But what seems strange to me is that they've created this, I guess essentially out of thin air, created this penalty, but it wasn't done through a legislative process, it was just done through an administrative process, correct? You basically had the IRS saying, well, we'll just up the penalty this time to 25%.
Yeah, absolutely. It's funny. It's funny how they did that, because I would think that they really don't have any real regulatory authority. Rahul and I have talked about this many times. This is not a law.
Right.
This was not passed by Congress, signed by the president. This is a regulatory, administrative process that the IRS came up with. It's actually a group of about 52 FAQs, frequently asked questions, that governs the program, that bureaucrats put together in Washington, D.C. And whether you like it or not, those are the rules. And now for the viewers that actually went through the program, they will realize that those rules are very, very strictly interpreted. And it's the way they operate. If it's not in those FAQs, it doesn't work, it doesn't happen. So it's not a law, but they follow it. It's odd.
I can imagine that if this same type of penalty were applied to just the general U.S. taxpayer, if you didn't file for a couple of years, you come forward and you say, all right, I'm going to pay my penalties, interest, taxes I owe. Oh, and by the way, now the IRS is going to take 25% of all of your accumulated wealth. I mean, there would be an uproar. But I guess because they've kind of narrowly limited it to this group of people, that they can get away with this.
Well, Chip, it's there are a lot of ethnic groups that did complain about
Right.
it, and when you read it, it is actually for the general taxpayer.
Right.
It's not targeted to any particular ethnicity or any particular country. It's targeted to taxpayers that have foreign assets, and it's non-discriminatory from that perspective, and that's why it survived, and that's why it there was no legislative action taken, and there were many letters written to President Obama,
Right.
the Treasury Secretary. There was a lot of lobbying going on, but the program stayed, and it went through to the very end. And I suspect that there's not going to be many significant changes to it.
Well, I want to follow up, Rahul, just quickly before the end of this segment, but this is not, again, the first time they've done this. You mentioned that this happened in 2009, now they've got a program in 2011. So what do you tell a taxpayer who says, look, I'll just wait it out, they'll have another one coming here pretty soon? I mean, based on past history, that's not unreasonable to assume that.
No, you're absolutely right. It's not unreasonable to assume that the IRS may do it again, because every time they come out with a program, they say this is it, this is the last chance. Yet they'll follow it up in a couple of years with another program, and quite a lot has been discussed in various tax practitioner blogs about whether there's going to be another similar type of program coming up. Most practitioners believe that there will be, probably in 2013 or afterwards. That's when the FATCA law about foreign bank account reporting kicks in. So I think at that time we'll see another program. Whether the terms of it will be similar or not to this particular program, we'll see. Whether they'll keep the 25% penalty or ratchet it up again. It's always kind of a problem with the law of diminishing returns. You keep putting a program, you keep ratcheting up the penalties, but that keeps dissuading people from coming into the program. So
Right.
Eventually, you're not going to have anyone coming in.
Does this thing, this is the last question we have, but quickly, does this thing really raise that much money for the federal government? I mean, we have a $14.4 trillion debt. I mean, this isn't paying off our debt.
No, it's not paying off our debt, but there is significant amounts of taxes and penalties that the IRS is collecting.
It's billions of dollars.
Billions.
Right?
Billions of dollars that are collected.
Yeah, can build some bridges to nowhere with that, right? We're not going to talk about that in the next segment, but we will in the next show continue to talk about taxes. So please join us at that time. For both Rahul and Parag, thank you, gentlemen, for being with us.
Thank you.
And we got more shows coming up on the issue of taxes and ways to protect yourself for the AAHOA educational experience. I'm Chip Rogers, and if you have any questions, please send me an email, chip@AAHOA.com. That's chip@AAHOA.com. Until next time, so long.